Okay, well, thanks very much, Fauzi. It's a pleasure to have this opportunity. As you see, I was asked to speak about what role trade policy has played in this most recent period of high prices for food. And the newspapers have often said, well, it's the contribution has come from the exporters who have been restricting exports, and that's been pushing up prices. So what I want to do is report on some research that goes a little bit beyond that and tries to look in particular at the role also of importers altering their trade restrictions, and see if we can apportion the consequences of each of those two groups of countries' actions on international prices for food. Now, Brian Wright's done some very nice work that shows that if you do have a period of low stocks of grain, then you are vulnerable if there's a shock such as an expansion in demand or a contraction in supply, for example, for weather reasons. You're vulnerable to one of these shocks, and governments can react to that, and trade restrictions are one of the ways in which they've been reacting to it. But what that does is exacerbate the extent of that price spike, and if you do the sums, it can actually not do very much in terms of reducing the extent to which countries are transmitting that price shock. So this applies when you have price rises, as in this upward price spike we've had in the recent years. It applies equally when you have downward price spikes, as we had in the mid-80s, for example, and that has implications for what the WTO is doing. So I'll finish up with a word or two on the implications for the WTO. So the logic of this, the political economy of this sort of action by governments using trade policy to bring stability or reduce the instability in their domestic markets, comes from the idea of loss aversion, that governments are trying to make sure that significant groups in their society are not adversely affected by such shocks. And so in the time of high prices, that's looking after consumers, and that's especially the case in the poorest of countries. And in the case of downward price spikes, it's looking after producers, the farmers who would suffer from that. So there's some work that Freund and Oslin have done in the AER that looks at this loss aversion and the use of trade policy for it, which is just an application of the Grossman-Helpman work. And that's the sort of background that we have in mind when we're looking at this issue. So if you think of a single market for a product, the international market for just one product, and then think of a shock, supply shock, for example, a weather-related shortfall, that shifts the excess supply curve to the left. And then think about what happens as different countries might respond. Firstly, exporters, secondly, importers, and then put the two together. So if you think of this as the shock that shifts the equilibrium from E0 to E1, raising the price from P0 to P1, and then we think about how governments respond to that. So exporters might respond by restricting their exports of rice, for example, shifting the excess supply curve for the world to the left further, and so raising the world price up to P2, but the domestic price in those export countries is down there at PX, so it's so they've somewhat insulated themselves with that price instead of P1. And if nothing else happened, their domestic consumers would be happier with that outcome. Then think of the importers who are also faced with this increasing world price, and what they might do is suspend their tariffs on imports as a way of not transmitting as much of that shock. And so they shift their excess demand curve to the right by having less import restrictions, and their equilibrium will be here. The international price will be raised even further to P dashed, but the domestic price will be down at this level in those countries. Put those two together and you get an even bigger rise up to P3 here in the international price. So these two country groups together are pushing up the price further than it would have been had they not reacted. But if they were just happened to shift these two curves in the way I've shown here by the same amounts, then the amount of world trade is still at Q1, which is what it would be if there was no reaction at all. The domestic price in those two countries is at P1. So they've done nothing to reduce the extent to which they have transmitted that initial exogenous shock. So this can be self-defeating if there was that full extent of response. Of course, there may not be, and that's an empirical question then as to how much response there has been. And of course, there's a transfer involved in that too from the food importers to the food exporters because of that terms of trade change. So this is a bit like people standing up. If you're all in the crowd and you all stand up, you can't see any better on average, although some can see better. The tall ones will see a bit better and the short ones will see less. So in this case, it's the food importers who are the short ones, the food exporters who are the tall ones, and in a downward price spike period, it would be the opposite. Okay, so what evidence have we got of this? There's been efforts by FAO, IFPRI recently as well, and the Global Trade Alert Group in Switzerland have been putting together data to get a sense of how much interaction there has been. And we just looked at those data recently, and there were, if you just restrict yourself to actions on the part of exporters and importers of farm products, there's been 45 export measures that have been altered and 85 import measures that have been altered in these last 3 years. So clearly both exporters and importers are responding, but that doesn't tell you anything about the magnitude of their responses, and it's only for the period of the last 3 years, so we're also interested in the period leading up to the mid-2008 food price spike. So what you need to do is go out and estimate the extent of the price distortions in these countries and how they've changed over time in the midst of these strikes, and then ultimately put that into a model and get an estimate of their aggregate effects. Well, the World Bank's database on agricultural distortions went up to 07 or 04 for some developing countries. We've since updated that a few years up to last year, and that provides us with estimates of the nominal rate of assistance to producers and the consumer tax equivalent to producers in 80-odd countries. And these two measures, the distortion on the consumer side and producer side, are almost the same, which is just telling us that trade measures are dominant in most countries that distort their agricultural markets. Well, these rates of distortion tend to be highly negatively correlated with the international food prices, and this is because there's not much transmission going on even in normal times. So we looked over the time period, did some econometric work to have a sense of that, and looking at the top dozen or so farm products, barely half of any international price change is transmitted to the domestic market within the first year. Those transmission elasticities for those three grains, for example. And if you just look at the rice graph, the dark line here, this is the global average weighted across countries by production. The black line is the international price, and you can see the dotted line, which is the nominal rate of assistance to producers, is highly negatively correlated with that. So if you want to try and get a sense of this, you'd throw it through a CGE model if you've got one and you've already got these estimates. Well, we've just got the estimates of distortions. We haven't put them through a model yet, but that's what we'll do shortly. But you can get a back-of-the-envelope estimate of it if you just use this equation for global demand and supply. You've got an exogenous shock there, V, that's affecting this, and we want to look at how governments respond to that by changing their trade taxes. So the trade taxes are captured in the T-hat there, and the international price on the right is a function of changes in those trade taxes and the shock itself, and shares of production and consumption in world trade and the related elasticities. So if you use that very simple model, make some simple assumptions about elasticities and about stocks, you can get some estimate of how much these changes in trade restrictions have impacted on these international prices. So that's the extent of the international price rises in those two periods, the early 70s and the most recent period up to 08. 09 they went down again, 2010 they came up, but so we'll leave out those last couple of years. And doing the sums here, the proportion of the contribution of trade tax changes to those international spikes are these numbers here. So what it's suggesting, these numbers are suggesting, is that about a quarter, or between say an eighth and a third, even a bit more down here, of the international price spike is due to these trade policy changes according to this simple bit of arithmetic that we're doing here. And just to finish off, we can decompose those policy contributions. So this is the total contribution in this most recent period for each of these products. And we can see that if you look at these columns here, that developing countries are slightly more contributing than rich countries are. That wasn't the case in the early 1970s spike, but it is the case now. And on the right-hand side, you can see the split between importing and exporting country contributions, and the sum of these two numbers is this number on the left here. So you can see there that the exporting countries are contributing a bit more than the importing countries, but the importing countries' contribution is non-trivial to this. And when you've got both of these things going on, they're offsetting each other in terms of being able to, countries being able to insulate themselves from that international price shock, but they're accentuating, they're each adding to the volatility of international prices by pushing that spike higher up. And finally, I think this is the last numbers slide. This is the numbers that were the percentage increase, like a doubling in the wheat price over this period in the international market. If we net out the contribution of the changes due to these trade policy, these trade restriction adjustments, then these are the rises you would get in the international price. In other words, if there was no policy response by either importers and exporters, the world price would have only risen by 78 instead of 127% for rice, for example. And then what we're seeing over here is the extent to which domestic prices rose in these countries weighted across, well, actually these are unweighted, I think, to get a sense of how much the domestic price rose compared with what it would have risen if every country had remained without any changes in their trade restrictions. So you can see here, for example, that that the world price for wheat went up by 100%. It would have only gone up by 84% if there'd been no reductions. And in domestic markets, on average across the sample of 80 countries, they went up by 98%. So there's almost a complete offset of the exporters and the importers, and leaving these countries with almost no increased stability as a consequence of these actions, but a lot of distortions to world markets because of those actions. So finally, what's all this mean? Well, it means if we are having these price spikes upwards, and we might get more of them with climate change and so on, that WTO commitments are not helping us in this situation because they're not restricting actions on the part of governments towards agricultural exports. So if there's no discipline on the export side, then these exporters can do what they've done in this recent period and limit their exports when prices spike up. Yet there are lots of other more direct ways in which they could be helping those groups that are that policy change is aimed for. On the opposite side, when you've got a downward price spike, the WTO is contemplating, or at least some of its members are pushing for a special safeguards mechanism that would actually do the opposite of what's required here. That would allow those countries to use import restrictions to protect their producers more when prices spike downwards. And so if we don't get more discipline on both of those directions, we're going to continue to have this contribution of governments to these price spikes. Thanks, Fazil.
Thank you very much.